So today I'm going to be talking about the 5 ways to bring financial clarity to your e-commerce or D2C brand. A lot of the potential clients, audits that I've done is I see companies that are leaving so much on the table because of flawed financial data. In fact, one client that we currently work with, they came to us, and again, this is no small feat, but they were doing, $8 million in annual revenue. However, their accounting methodology, so they were on cash basis instead of accrual, we transitioned them over, but they could not see their true profitability month over month, right? One month they make a ton of profit. Next month, it's actually losing, and they couldn't make strategic decisions. So we transitioned them, got everything in alignment. The next year they did 25 and on track to do over 50 this year. And it's like, that is the eye opener of what can happen to your business when you truly understand your numbers. So let's get into it. So number 1 is you first want to establish the right financial methodology. Now, what do I mean by that? Well, anytime you're dealing with inventory, you want to be on accrual basis. And I don't want to get bogged down with like accounting terms, right? But basically you want all of your costs to be aligned with your sales. The biggest one being inventory or your cost of goods sold. So you don't want it documented, that transaction on your profit and loss statement when you actually order all that inventory. That's an asset in your business and should be on your balance sheet. So, you sell 100,000 and you have a cost of goods of 20%, then there should be 20,000 expense aligned with that monthly sell. And this in and of itself can bring extreme clarity. Now, what else do I mean by methodology? I mean the way that you structure your chart of accounts. So you don't want to be going through the entire profit and loss statement each month if you don't need to be. Now, is it wise? Yes. But you want to structure the chart of accounts in a way specific for e-com brands so that you can truncate it and you can quickly see what's happening. And so what do I mean by that? You want to have your revenue, you want to have your cost of goods, so sale of the product, so the product cost for each sale. Then you want to have selling expenditures. And in this, we include advertising and marketing, we include shipping, and we include merchant fees. So then right below that, you get your contribution profit, which I'll talk about. And then below that, you have your overhead. So if your contribution profit is less than your overhead, then you're not profitable, right? And it gives you this clear snapshot on the different areas that you need to focus on within your business directly from a financial statement. Now, number 2 is the cadence. I get it. A lot of times you don't want to deal with the financials. You don't want to look at the financials. You don't want to review it, but that's where the truth is. That's your report card for your business. So at a minimum, you want to be reviewing this on a monthly basis, and you want to make sure that you're getting those completed by the 10th. We push to have it done quicker than that, but at least by the 10th, so that you're not going further into the month before you can review the previous month's data. And if you have to make adjustments, that next month might already be over, right? So you want to be reviewing your KPIs, you want to be reviewing your financials on a monthly basis. Now, the type of KPIs that you want to be reviewing, you want to understand cost of goods sold, percentage to revenue, you want to understand your gross profit and percentage, you want to understand your contribution profit, and you want to understand your net income. We actually break that down so that you can see, like, what's my percentage of overhead to my top line sales? What's my percentage of selling or shipping, right? So then you can quickly see the historical data and you can understand, like, oh wait, why did this go up? Why did this go down? And it just gives you clarity into your business. Now, outside of financial metrics and KPIs, ones that we like to look at or stay on top of and look at the history and how it's fluctuating is your customer acquisition cost, your customer lifetime value contribution margin, because you can quickly take that over your customer acquisition cost and you can understand at what point or how long it's taking you to break even on the investment you've made, the ad spend, to acquire that cohort of clients. So that's a huge one. You also want to look at your email performance. How is email performing? How much of a percentage of revenue is email contributing? For most D2C brands, kind of the baseline, the benchmark is, we want that at least 30%. And the reason is because you've already paid for these customers, right? So you want to continue to provide value to them and extract revenue in exchange for your goods. The third thing is you want to understand your true acquisition cost. People can have spreadsheets built, you can understand what your cost of goods is, but the true reconciliation happens on your financial statements because everything's attached to your bank. Every expense is coming in. Once it's truly reconciled, every expense has been categorized, matching your bank, your credit cards, all expenses that are coming in. And so if you just have that on a spreadsheet, like freight in might have gone up and that changes your cost of goods, right? But so you want to be able, like, if you're dealing with the spreadsheet, that's good to get your unit economics, but you want to make sure that that's matching like your P&L, like it's not wildly off where, the spreadsheet is showing your cost of goods is, like I said, 20%, and then your P&L is like at 25%, because that's going to throw off your metrics. Number 4, we want to understand email performance. And again, kind of like what I hit on, you want to understand how much your email is contributing to your top line revenue. And we can get into attribution and the way most people are on Klaviyo, other people on Zenlane, but the way that they attribute that data. But really, we want to look at the trend here. So as you're looking at that, give yourself a goal that email needs to be producing at least 30% of our top line revenue. We have some clients where their customer lifetime value is extremely high and they're above 50%. Where so like once they acquire these clients, man, they are just providing excellent goods to their clients and they're coming back and repurchasing. And to dig in a little bit further, you want to understand your flows versus campaigns and what's performing the best, right? If you can work on your flows to really get that, kind of creates more consistent revenue that's coming in, where the campaigns is the shotgun blast, right? When you're running sales, promotions and different things. So those are some of the things that you want to look at from your email list. You want to look at number of recipients, value per recipient to see like, okay, if are we emailing too much? Is the value per recipient decreasing, right? And so all of these kind of just give you a snapshot into, again, the whole goal when you're looking at data is to make strategic decisions or to continue to do what you're doing, right? Do you need to make adjustments? Is there something that's off? Is the yellow flag kind of being raised? And so that's why we look at email performance, because your email is potentially one of the biggest assets in your business that's not shown anywhere on your financial statements, right? So like it's the value of your email list isn't shown on your balance sheet unless you acquired it, but typically not. So you want to take care of your customers because that's the golden goose that's laying those repeat purchase eggs, right? That doesn't really make sense, but you know what I mean. It's your golden goose. So you want to take care of it. You want to nurture it. You want to make sure you're not over emailing. You just want to stay on top of your email list because it is one of the biggest assets that you have in your brand. Last thing is, and this is vitally important as well, is you want to develop a reliable cash flow forecast. And the reason why is because when we make all these adjustments that I talked about up here, is you're going to get to the end of the month and you're going to be like, wow, we had great profit this month. Why did we lose cash? Well, a lot of that, most of that, if you had to order inventory, is not reflected in your P&L. That's an asset on your balance sheet, right? So you just want to understand how inventory, supply chain is affecting your cash flow, and you want to understand how much inventory you have in stock. And so you want to monitor that, because if you have too much inventory in stock, first, we never want to run out of inventory. So we want to have like just in time. That would be the perfect scenario. But you also don't want to have too much inventory in stock that it's eating up all of your cash and limiting other areas that you could invest in your business. So, there's simple ways that you can do that, but you want to be able to look out several months to understand where potential cash shortfalls might happen and get ahead of it, right? So that's all forecasts are doing. It's like giving us a depiction in the future. And as long as it's pretty close, then we just want to look at that and make strategic decisions from that data. So those are the 5 ways that you could bring financial clarity into your e-commerce business.